Good afternoon, and thank you all for joining us. I'm Steve Gerard, and I'll be moderating today's Compensation Committee webinar, Long-Term Incentives in the Age of Pay for Performance. We're going to try to address many of the questions we as directors have when trying to determine whether we have created a strong alignment between pay for performance in our executive compensation plans. We will focus on long-term incentive design and metrics and how to view the current trends in TSR use. We're joined today by Matt Turner, Managing Director with the compensation consultancy firm Perlmeyer, and his colleague Brett Herrand, who are both located in the firm's Chicago office. They're going to walk us through some questions and answers around the role of the proxy advisory firm's pay for performance tests and their impact, and more importantly, how to effectively link your business strategy to your incentive programs. Before we get into the details, Michael Kelly with the National Association of Corporate Directors Education Team has a few housekeeping announcements.
Thank you, Stephen. Good afternoon, attendees. You can feel free to submit a question and receive your answer directly from Perlmeyer. You will also be opted in to receive future executive compensation thought leadership from Perlmeyer. You can tweet live with us today with the handles @NACD and @Perlmeyer. The presentation slides are available for download at the link that you see on the screen and within the webinar console at the bottom right-hand corner. You will automatically receive 1 NACD credit for your participation. Credit may be applied to NACD fellowship programs. You can contact fellowships at nacdonline.org for more details. The replay and slides will be available early next week at www.nacdonline and www.perlmeyer.com. Matt, over to you.
Great, thank you, Michael. So we've titled this webinar "Long-Term Incentives in the Age of Pay for Performance" because it seems like the pay for performance tests of ISS, in particular, Glass Lewis to a lesser extent, and the upcoming required disclosure of pay versus performance from the SEC are looming quite large. I'd like to take just a minute or two to talk about how we got here, and then we'll go into where we are today and answer a few questions in sequence. So if we roll back time 10, 15, 20 years ago, if you asked anybody in corporate America about their compensation philosophy, inevitably the words pay for performance would come up. The phrase was a universal bromide, and when CDNAs became a required disclosure, you found the phrase everywhere in everyone's CDNA. We think about what happened in the early part of the decade. Sarbanes-Oxley strengthened pay governance with majority independent director requirements and some other indirect impacts from the Sarbanes-Oxley rule, including increased focus on executive pay. So the spotlight was on during the knots. Going into the 2010s, Dodd-Frank Act was passed in response to the financial market crisis, and the say-on-pay requirement was adopted in 2011. ISS and Glass Lewis, the institutional shareholder services, began quantitatively evaluating executive compensation programs with pay for performance tests. We also know that embedded within the Dodd-Frank Act and with the SEC required disclosure coming forward, pay versus performance is another way to think about pay for performance analysis. That reg remains pending, but could be implemented in the near future. In response to all this, companies and parenthetically their consultants began to accommodate the ISS and Glass Lewis tests. If companies were going to be evaluated according to these tests, it makes sense to pay attention to them, and where it's feasible, make sure that you don't run afoul of those tests. But what also happened is companies and consultants started countering these tests and thinking about where some weaknesses are in the tests, and countering with their own alternative pay for performance tests or pay for performance diagnostics. We started hearing terms like realized and realizable pay. We started seeing voluntary disclosure of supplemental information in addition to what's required related to pay for performance. So a lot's been going on, and we'd like to address a few questions in sequence and then talk about where we think companies can benefit from looking at long-term incentive programs and strengthening the relationship between pay and performance and strengthening the relationship between your incentive plans and your business strategy. So first question that comes to mind is, has the incentive plan and LTI in particular, has it changed much in the last several years? And the answer here is yes. We'll go into some of the detail of what we're seeing changing on the next few slides. The next question that comes up is performance improved? And the answer here, as far as we can tell, is no. We've got some evidence we'll bring to bear on this as well. But going beyond that, we could also ask, is executive compensation better aligned with performance? So if we're not necessarily driving improved performance with what's been going on in executive compensation disclosure, is anything getting better in terms of alignment? And the answer here is perhaps. It's not quite clear. It may be some places and maybe not in some others. And then finally, we'll go into how should directors think about long-term incentive measures and goals and plan design to make sure that pay is aligned with performance. And here I'll turn it over to my colleague, Brett.
Thanks, Matt, and good afternoon, everyone. This is Brett Heron with Pearl Meyer. The first question that Matt posed was whether incentive designs, and particularly long-term incentive designs, have changed in response to this focus on pay for performance. Again, as Matt mentioned, the answer to this question is pretty clear in that LTI designs over the past several years have certainly evolved and continue to evolve. This slide here, we discuss a few of the key themes we've observed in LTI designs over the past several years. And this, the items we have listed here probably shouldn't come as a surprise to anyone, given how much we've been talking about these things for the past several years. But the first one, the increase in total shareholder return or relative total shareholder return as an LTI measure. Certainly there's been a lot of talk about long-term incentives and using total shareholder return as a performance measure within the LTI plans. And certainly this has continued to evolve, and we expect it to continue to evolve as companies reevaluate the role of TSR within the LTI plan. The next theme that we've observed is really around the portion of LTI delivered in performance-based vehicles, and certainly we have a slide on this that looks at how the mix of performance LTI has increased as a percentage of total LTI going back several years. The next theme that we continue to see play out with LTI is the decrease in prevalence of stock option usage, and this even goes back to the mid-2000s when stock option expensing became required under GAAP, but this continues to change as companies reevaluate again the mix of the various LTI awards. Number 4, more universal acceptance that LTI refers to periods of longer than 1 year. You typically see the standard LTI cycle being 3 years, but certainly more and more companies are saying long-term performance is a period longer than 3 years. But as it stands right now, most long-term incentive plans are focusing on cumulative performance over a full 3-year period. Greater consideration to non-financial performance dimensions, and this is somewhat of an emerging trend, but we continue to see companies think more critically around some of the non-financial performance dimensions that might be important for incentive compensation programs. Things like brand value, sustainability, customer, some of the other environmental, social governance types of things out there that, at the end of the day, probably have and represent real value as it relates to shareholders. And then finally, just a quick comment on LTI eligibility. Again, when stock option expensing became mandatory back in 2005, I believe it was, we did see companies start to make some changes to LTI eligibility in response to that. But I would say since then, we haven't seen the needle move too much on LTI eligibility. next slide gets specifically at the role of total shareholder return within incentive compensation programs. And this slide really sets the stage for the next several slides where we talk about TSR. But this slide looks at the prevalence of TSR plans in the S&P 500 going back to 2004 through 2013. And as you can see, the prevalence of TSR plans steadily increased over that time period. And even if we tack on 2014 and 2015 onto the end of the slide, then we would see the prevalence of TSR plans climb to above 50% prevalence. So that as a backdrop for the rest of the presentation here is important because it's certainly the driving one of the key drivers of companies considering changes and refinement to their LTI programs. At the same time that TSR has been growing in prevalence, performance-based LTI awards are representing a larger and larger component of the total LTI opportunity. If you go back to 2011, performance-based LTI, which is going to include performance shares and cash LTIPs, represented 46% of total LTI grant value. And now we're in 2015, performance-based LTI awards reflect 54% of the total LTI framework, and this is focused on CEOs for a subset of the S&P 500. Now, those increases in performance-based long-term incentives have generally come at the expense of a declining prevalence in stock options. And again, while the decline in stock option prevalence began a while ago and somewhat driven by the requirement to expense stock options, it has continued in the age of pay for performance, with a sense from some out there that stock options are not considered performance-based. And I don't think we're going to try to answer that debate here on the phone today, but it is at least worth noting that fact. So that's how LTI has been changing in the age of pay for performance. So the next question is, have we actually seen improvements in performance as a result of compensation plan design? And our answer to that question is no, not really. It's impossible to say if U.S. companies are actually performing better today than they would have in the absence of Dodd-Frank, ISS, and some of the other drivers of evolving plan designs. But we can look across companies to understand how pay programs are designed and how well these companies might perform relative to other companies with different plan designs. And we've been doing some research over the past several years with the Institute for Labor Relations at Cornell that tries to get at that question. In 2005, we published some of that research, which we're summarizing here on this slide. This research really focused on long-term incentive plan design at companies in the S&P 500. Some of those key findings from that study, as it relates to performance and the role of TSR, and companies that had TSR as part of their LTI framework, we found no evidence that the inclusion of TSR leads to increased firm performance. And in fact, we observed some weak evidence of a negative correlation between using TSR as an incentive and stock price performance. We also found a negative correlation between TSR and revenue growth in the following year, and a slight positive relationship between ROE and stock price performance. So when we look at the prevalence of TSR-based plans, as we noted a few slides earlier, we have seen the prevalence of TSR increase precipitously over that 10-year time period, and that increase in prevalence really held true across all industry sectors. When we look at the pay mix, as I mentioned, the prevalence has increased. The prevalence of TSR-based plans has increased, but as the prevalence has increased, the relative weight of TSR in LTI has actually decreased over time. So as new companies added TSR to their framework, it was generally at a lower weight within the overall LTI framework. And we also found that larger and less profitable firms were most likely to add or increase the weight of TSR in long-term incentive programs. Over the last several years, we've seen some other trends in the role of TSR. Companies, in the past, companies were often using relative TSR as the sole performance-based measure in an LTI plan. More and more, though, companies will use relative TSR in combination with another financial measure. We see companies, again, after we've had several payouts under LTI, under these TSR plans, companies are reevaluating the role. Companies are using TSR as a modifier to financial performance results. So if a plan funds an award based on financial performance, TSR might then act as a modifier to the financially funded award. We've seen companies use TSR as a limiter to the final award value. That's a plan where TSR would on the back end limit the magnitude of the award, and then also we might see TSR act as a cap on being used as a cap on the ultimate value of award, and that's somewhat of an accounting-driven design provision, but it's another way that companies have used TSR in a kind of alternative framework within the LTI design. Last bullet point here. ISS and Glass Lewis have started to preach that LTI targets LTI goals should exceed the median, or that perhaps plans shouldn't pay out anything for below median TSR. Now, this line of thinking is somewhat consistent with the way that LTI gets delivered across the pond in Europe and the UK, but we don't see that necessarily happening as it relates to with US pay practices. If we go there, it's going to be several years from now at least. We're certainly seeing it discussed, and ISS and Glass Lewis are commenting on it, but we haven't really seen a rush to adopt that kind of a plan. The one big problem with this approach is that companies will end up granting more value to make up for the risk-adjusted expected value, and so you end up granting more shares in the process. It's somewhat similar to premium-priced stock options when companies started exploring that model back in the mid-2000s and realizing they had to grant significantly more stock options to grant a similar award value.
Brett, while we're talking about trends in TSR, could you comment briefly on the prevalence of TSR in small and mid-cap companies and directionally where you see that going?
Sure. So, with any type of executive compensation trend, we certainly see the larger companies start to adopt those trends first, and you see kind of those plans and practices kind of cascade down to the mid-cap and smaller cap companies. So they've certainly been slower to adopt those kinds of plans. But I would say that at this point in time, the TSR thing has been around long enough that we see similar kind of prevalence levels, similar levels of prevalence for our TSR designs at mid-cap, maybe not so much at smaller cap companies, but certainly at the mid-caps.
This is Matt. When I think about companies in kind of the $1 to $5 billion range, I'm hard-pressed to think of a client example where the peer group didn't have relative TSR as the single most prevalent measure. Even if it wasn't quite over 50%, it was the single most prevalent and strongly in the 40% range.
Sure. So the next question that we posed is, are we seeing better alignment of pay and performance? The answer is not entirely clear on this point. We went back to some of our client work to help us answer this question. The exhibits on this page show 3-year realizable pay for a group of CEOs arrayed against 3-year TSR. The exhibit on the left is for 2009 through 2011 period. The exhibit on the right is for 2013 to 2015. And for this group of CEOs, the answer is a resounding yes. We certainly observed for this client's peer group much better pay and performance alignment. However, for a different peer group, as shown on this page, we get somewhat of a different story. And again, the chart on the left looks at 3-year pay and performance alignment for 2008 through 2010. And the chart on the right looks at 3-year realizable pay for 2013 through 2015. And for this group of companies, we didn't really observe much change in pay and performance alignment across the peer group. So again, I think the answer to this question is still a TBD at this point. Maybe a few more years will give us a little more, a little bit broader of a rear view mirror to hopefully answer this question. And this is going to take us to our first audience poll. We are curious what you think about pay and performance, and specifically when you think about pay and performance in the context of executive pay and incenting and rewarding senior executives, what sort of definition of performance is most appropriate? So when we think about the definition of performance, how should performance be defined for a CEO? And if you'll take a few seconds here to cast your vote. 4 options: 100% total shareholder return, either relative to peers or broad market or index. 2/3 TSR, 1/3 key financial measures. Option C, 40% total shareholder return, 40% key financial measures, and 20% other. Feel free to define other how you'd like. And the last option there being 25% total shareholder return, 25% key financial, and 50% other. Other could be customer, could be market share, could be brand value. There's lots of different types of measures that you might consider throwing in the other bucket. We'll give people a few more seconds here. And let's go to the results. This is great.
Wow.
Yeah, I'm very surprised. It sounds like you are too, Matt. A lot of support there for 40% TSR, 40% financial, and 20% other. So it's obvious that most believe the definition of performance is something broader, much broader than just TSR. And in fact, the proxy advisors are somewhat moving this direction, although somewhat inelegantly. But I do think this certainly gives us, as consultants, a lot of room to discuss with our clients around how we might consider further migrating the performance framework to start to pick up some of those other dimensions of performance.
And Brett, when you think about those scatter plots that we were looking at a few slides back, and we've got, one larger company client example where we saw some alignment, but another kind of a mid-cap company that, it's just the scatter plot doesn't change much over time. My sense is, and this goes to conversations with compensation committees, is compensation committees aren't accepting the 100% total shareholder return definition, that they're accepting something more in the category B or category C boxes here, and it's reflected in the way compensation is designed. And so even while we see relative TSR getting more attention, it isn't necessarily going to create a lockstep alignment of pay, pay and performance according to that very straitjacketed definition.
Sure.
Steve, I wonder if that's consistent with your discussions on your boards in terms of thinking about performance as being either all total shareholder return or picking up the other elements we've talked about here.
Yeah, it's very consistent. I'm not personally familiar with any company who has a total TSR as the only goal. I think that most compensation committees understand the strengths of it and, quite frankly, the significant weaknesses of it. And to the extent they want to use TSR, it's just one of many components.
Great. All right, Matt, I'll pass it over to you.
Okay, great. Thanks, Brett. So what I'd like to do here is get a little bit practical. Go back to the slide here. So, we just saw that there seems to be raging agreement that 100% TSR is not the answer to what is performance in our company's pay-for-performance definition. And the fact is we have to live with ISS, Glass Lewis, and the external evaluations of pay-for-performance. But when you think about your role on the compensation committee, you think about making sure that pay versus performance is appropriate to your company context, is there anything you can do? And we think the answer is yes. We think that a tailored definition of performance and periodically running diagnostics of how your pay and performance are lining up ex post, not just looking at grant value of compensation, but looking at what kind of compensation is being realized or realizable versus our definition of performance, is a healthy exercise to make sure your programs are tuned the way you want to. What I'd like to do is share a case example here to provoke some thinking. This is of a large multi-line mutual insurance company. They are very dedicated to the idea of pay for performance and quantitatively testing it. But for this company, the concept of total shareholder return doesn't make any sense. Shareholder value is a more complex idea since the policy owners associated with the company, the customers, are also the claimants on the residual equity value of the company. So they're kind of commingled in terms of their interests. And so the definition of value is more holistic when we think about value creation. What we did with this client is we helped them define a definition of performance that fits with their business model and their reason for being in existence in the first place. And long story short here, what we did is we created kind of an above-the-line and below-the-line framework, where above the line we focused on the key centerpiece financial measures that are important for defining value creation. They are growth, profitability, and capital strength. And in this particular case, growth is defined as growth in net written premium, profitability is defined by the combined ratio, and capital strength is defined by the risk-based capital ratio, and we can evaluate how the company is doing against the appropriate peer group against each of these three key measures. Then we've got measures below the line that get at some of the drivers of long-term value creation that are a little bit harder to quantify, such as customer satisfaction and strategic leadership. With customer satisfaction, there are some metrics out there, and you can rely on some of the external third parties that are doing surveys. But it's still, even when it's quantifiable, it's still one of those measures that can be somewhat subjective. So we put it below the line for a plus or minus 10% based on a subjective evaluation of performance. And the same with strategic leadership. And this is the case with any organization. This is a really hard thing to quantify, but you kind of know it when you see it. And if a company is going through a period of integration or some key challenges, you have a sense of how your leadership team is doing. So what we do is we generate an objective score above the line. We allow it to be adjusted plus or minus 10% by these other factors, and we use that as our assessment of performance in the pay to performance comparison. Pay is compared kind of the same way we do for public companies, just looking at realized pay for these companies since they don't have carried equity in a mutual insurance organization. So the point here is there are companies out there that are taking the time to define performance in a way that makes sense for their business model. And our point of view is that even publicly traded companies that have to pay attention to ISS, it is still worth the time and effort to think about your definition of performance and make sure that your programs are aligning the way that makes sense for your business.
Could you comment briefly for the directors listening on those companies, and this is probably more small and mid-cap companies, who have a hard time determining a realistic peer group because of their product mix, and how applicable TSR might be for those companies?
Sure thing. The short answer is this is a tough nut to crack for some companies more so than other companies. And we have a case study later on of a company that really resisted a relative TSR measure for precisely this reason, in terms of a very difficult time creating a peer group. My practical answer here is that there are some analytics and diagnostics you can use to try to develop an appropriate capital markets peer group, or to test out different indices out there that might have similar trading patterns and covariance in terms of the way your company trades, to create a reasonably good match for relative TSR. But even with that, and assuming that you're not going to be entirely satisfied, I go back to one of the slides that Brett covered in terms of how TSR is being implemented. One of the things that companies do on this is to say, well, we're not going to carve out 30 or 40 or 50% of our LTI attached to TSR. We're going to have it be a relatively smaller portion. And in fact, if you look at how TSR has been implemented by companies in the last 10 years, they have been making it a smaller portion of their total LTI. The second thing is to say, well, look, we're only going to adjust our LTI awards if our TSR relative to the market is extremely high or extremely low. If we're in that range between the 25th and 75th percentile, we'd rather focus on what we know to be our centerpiece financial measures to determine our award payouts. So the last couple slides we've covered kind of beg the question, if TSR is not driving improved performance, and I think the findings from the research we did a couple of years ago really drives that home, the natural next question is, are there any other key financial measures that we know are going to drive performance? And the short answer is no. There aren't any silver bullets. We've actually done some additional research. It's as yet unpublished, so I can't share all the details here, but we've looked at the link between particular financial measures that are common in long-term incentives and whether or not they are drivers of firm performance, and there just isn't any evidence. The point is that there's going to be a lot of time and effort that needs to go into making sure that the measures you have in place are specifically appropriate for your business strategy, and the industry and economics that you face. Just as an aside, we mentioned TSR isn't driving performance. We didn't find a relationship between other particular financial measures. We also took a look at the relationship between the percent of long-term incentive delivered in performance-based vehicles, and we found there's no relationship between firm performance and this characteristic as well. So while ISS and other bodies like to see at least 50% of long-term incentive delivered in performance-based vehicles, there may be good reasons to do that from an alignment standpoint and from a governance standpoint, but it doesn't necessarily drive firm performance. So, back to the rhetorical question here, does anything matter? And luckily we have, another 15, 20 minutes of presentation, so the answer is yes, and we're going to cover that. So we actually think that, it's helpful to look at what's going on in the marketplace and amongst your peers to understand LTI practices, but it doesn't necessarily provide you the roadmap to what is appropriate for your company's executive compensation program. We think that selecting the right metrics, designing effective incentive programs involves taking a look at your specific business strategy, your specific leadership strategy, and the demographics of your executive team, and making sure that your program fits specifically to what's going to help you drive the execution of your business strategy. If we think about an objective here of getting good alignment between pay and performance and driving performance, there's a lot of links in the chain here. And in fact, any of these links, you can tweak them to revise and refine the results you're getting in realizable pay versus performance. It matters the peer group and the market that you're comparing to. It certainly matters how you're positioning your target pay, your grant values of compensation. The starting point has an impact on where you are at the end point. Certainly pay mix, how much is in fixed versus variable, how much is in short-term versus long-term, how much is in cash versus equity, has an impact on the leverage, and depending on your definition of performance, it can have an impact on whether or not you're getting alignment with that definition of performance. Plan design matters as well in terms of making sure the mechanics, the way your plan works, is appropriate to your situation. Do you have the right kind of leverage around the target payout from 0 to the maximum? Is it a 2x maximum, a 3x maximum, or something like that? Do measures impact the plan in different ways? Is it simply a share of a scorecard, or are you using measures as a modifier? Performance linkage, and these last two categories will go a little bit deeper on the next few slides. The performance measures that you choose and how they're linked into your compensation program matters immensely. You want to make sure that you've defined the centerpiece financial measures for your business appropriately. That is, what are the measures that best define profitable growth and returns in your business for your business strategy. Make sure you're supporting those centerpiece financial measures with key operational and strategic measures that are part of your driver tree. What's really important in terms of making decisions that are going to drive performance of those financial measures over the long term. You want to think about whether it's appropriate to measure performance on an absolute basis according to your business plan or cost of capital requirements or other return requirements, or whether or not it's appropriate to measure performance relative to a peer group. And in what balance, what percentage focus on each of these aspects. And then finally, goals and performance range. Once you know the performance measures and you've got those balanced appropriately, it's important to make sure you define what really is exceptional performance, worthy of max or near max payouts in your incentive plans, and what's acceptable performance that might define where your target or your threshold performance might be, and how you get to that range from threshold to superior to make sure it's reasonable and relevant. And think about what kind of inputs you are bringing to the table to arrive at these answers. So just a note about where the measures come from and where they fit in. We like to think about this as kind of being visualized by a pyramid here, that every publicly traded company has a goal of maximizing shareholder value. It's almost a throw-off. We know this is the case. Where it really starts to get interesting is how are you and your company specifically going to create value? And that gets into your specific business strategy, the market economics that you face, your competitive positioning against peers and competitors, what are the strengths and weaknesses of your company, and what are ultimately the pathways for your company to create that shareholder value. This should lead directly into thinking about the centerpiece financial measures. What are the specific and relevant financial measures that balance growth and returns that are important for your business strategy? And then thinking about behind that, and you can kind of visualize the DuPont ROI tree as well, what are driver measures? What are the aspects of performance that start to get into operational performance and day-to-day decision-making that are going to help you drive performance along the lines of those financial measures? Now, there's an important point that comes at the next slice in the pyramid here, and that is the middle two slices here are going to give us a picture of what the appropriate measures are. But keep in mind that you have multiple corporate processes and information systems to help managers make good decisions. Incentive compensation is one big important part of this slice, and there are other pieces around planning functions and reporting and resource allocation functions where measures are going to be important. And the bottom line here is we're going to identify measures that are important for creating value, but not every measure that's important for creating value belongs in an incentive compensation program. There are practical issues around why certain measures might be appropriate or not appropriate for incentive compensation. You want to think broadly to make sure that the measures are covered somewhere in your corporate processes, but they don't necessarily have to be in the incentive compensation program. And if we've done all this right, we believe this can lead to improved operating decisions. So I mentioned that DuPont ROI tree. The inset here is just kind of a generic picture of a DuPont ROI tree that helps us, informs us about the kind of measures that might be appropriate for incentive compensation. We find it helpful occasionally to map out all of the incentive compensation programs, and we could even extend this beyond incentive compensation to other management systems to make sure that we are getting the relevant performance measures mapped into the systems appropriately, in the right weight, and avoiding redundancy. There are times when I've been in conversations around incentive plan design, call it the annual incentive plan, and you end up in a tendency where, well, there's 3 or 4 measures we want. Well, we really need to pay attention to inventory, and gee, we really want to make sure ROIC is covered. The point I'd like to make is if it's covered in your long-term plan or if it's covered in some other plan, you want to take that into consideration to avoid redundancy. So think about mutually exclusive, collectively exhaustive. Have we got the map of how we create value grafted into our incentive compensation program in a way that makes sense across short-term and long-term incentives and equity-based incentives? next thing I want to cover is when you think about especially the centerpiece financial measures, but it could pertain to inventory measures or other balance sheet measures, give consideration to tailoring your performance measures. There's a couple of dimensions here. One is you want to make sure that the measures you're using are as close to economically relevant and fit with how you create value as possible. But at the same time, you want to balance out the complexity or opacity that comes along with tailoring performance measures against that. In other words, if we're going to make 2 or 3 adjustments to how we calculate ROIC, we want to make sure we're getting good bang for the buck, that it's helping our managers better understand how we create value, and it's worth the additional communication, both internally and externally, to make those tailored adjustments. And there are other practical issues around tailoring measures that you may want to do anyway, and that has to do with looking at tax rates that you face and what do you do about actual versus statutory tax rates. And we've got a potential issue around a change in corporate tax rates in the future. That's going to be a big question on everybody's plates over the next year or so. You want to think about what you do with non-cash charges, how you handle foreign exchange. Inventory valuation is really important. And, of course, goodwill and other non-GAAP assets, thinking about managing investment in the business and how you account for returns against those. These questions become very important in terms of making sure that your measure is both relevant and fair to both the participants and to investors. Another big one that always comes up is how do you deal with acquisitions? You want to think through those questions ahead of time as opposed to at the back end. And generally speaking, we like the idea, if you're using a return measure, of suspending investments from the calculation of a return measure in the given year if it exceeds, say, 20% of the balance sheet, and incorporating it into future years for a multi-year calculation. So I mentioned this case example earlier. Let me just hit this quickly so we can get into questions towards the end as well here. This is a smallish cap industrial company. Their business strategy involves establishing and maintaining operational excellence and leading to competitive advantage in the collection, recycling, and processing of scrap metal. We do have some ancillary businesses related to that as well. Margins and stock price for this business are highly sensitive to global scrap metal prices. They move wildly when global scrap metal prices move. They're a small player, I mentioned, and the issue here, back to Steve's question about constructing a peer group, they only have 1 or 2 publicly traded peers that are reasonably close to their business model. The other competitors are divisions of other public or even private companies around the world that they face. So it's difficult to really do a traditional value driver analysis, looking at measures that are driving value within an industry, because we don't have that robust peer group. But we did find it useful to work with the client to map the firm's value chain, understand those key levers of value creation and what's important, understand where the exogenous factors like scrap metal prices impact the drivers, and isolate in on some measures that are important for decision making, but less useful for incentive design. Make sure those are incorporated into the decision making processes outside of incentive compensation, but focus on the things that management can control and influence. Bottom line, their system has an annual incentive plan with half focused on earnings, and then the remaining half divvied up between different aspects of performance in a scorecard that they deemed important for their business. Strategy measures, cost-saving measures, an inventory management metric, and safety, which was important in their business. Their long-term incentive plan is divided up 1/3 in restricted stock, 1/3 in performance shares related to relative TSR, and 1/3 related to cash flow return on investment. This was the key measure they said their management had more control over, rather than a gap-based ROIC type measure. So this is working for them. They were resistant of a relative TSR measure for a long time because of the difficulty with the peer group, but they've incorporated a couple of features that Brett talked about on the earlier page, and they're feeling pretty good about the balance of LTIP today. In terms of setting performance goals, as I mentioned, we want to make sure they're reasonable and relevant. If you think about, good rule of thumb over a 10-year period, you think, you ought to be achieving target or better 50 or 60% of the time. You're hitting at or near maximum maybe 10 or 20% of the time. and you're falling below threshold maybe 10 or 20% of the time over a 10-year period. The important thing about this rule of thumb is this is for an average company over time. And in fact, if you really are a high-performing company, you should expect this bell curve to skew to the right. And if you've hit kind of a rough patch in terms of performance over time, it should skew to the left. How do you know if you should skew to the left or right? Well, for a public company, you can always take a look at how you've been performing in total shareholder return relative to a peer group as a hint or clue as to where you should be in that bell-shaped curve. The goal-setting process itself, I want to underscore here that this is really important for compensation committees, that the process has really changed over the past several years. The traditional approach was largely budget-driven, target-focused, just focusing on what the target is with kind of a generic plus or minus 10% or 20% around target. And then the compensation committee is reviewing recommended targets at a meeting in say, February at the end of the process. That's not going to fly today. We think that today's required approach requires multiple performance perspectives, understanding more than just a bottom-up budget process for getting to the targeted performance, multiple pay and performance scenarios, understand what the variance could be around future performance and build that into the performance ranges for your incentive plans, consideration of HR and other executive personnel matters, who's been on board and for how long, who's responsible for where the company is today, and taking that into account in performance goals, and early active involvement of the compensation committee. February is too late. December is much better, and November is even better than that to begin conversations about what the goals are going to be for the coming year. It doesn't mean you know what the answers are, but it means you're reviewing some of the inputs earlier to make sure that everybody's getting 2 and 3 bites at the apple before you're asked to approve final goals for the coming year. Again, this is just reinforcing the idea that goal setting should incorporate multiple perspectives. What I want to do is show you a little bit more how we do that. We take a look at each of those perspectives on the prior page and build it into how we understand values created at the company and think about the measures that are built into the incentive plan. We can effectively gain a perspective on what a reasonable goal or performance range might be from each of these different perspectives. And I wouldn't recommend that you just apply a straight mathematical equation to kind of take the mean or the mode out of these perspectives, but consider these perspectives, which of these might be more or less important in a given year in terms of thinking about the goals for the coming year. And visualizing those ranges can help you get to a better agreed to consensus around what the appropriate financial goals and ranges will be for the coming year. Likewise, thinking about the scenario planning, understand where the potential variances to performance might be, and this can help you understand how wide or narrow a performance range might be, or even if the performance range should be asymmetrical. In other words, maybe you've got an awful lot more downside built into your plan than you do upside. So the downside from target might be wider than the upside is to get to maximum. And the converse might be true as well. There are some goal-setting pitfalls, and these certainly aren't exhaustive, but these are the ones that come to mind when we think about what we go through with our clients. Number one, relying principally on the company budget process. We've kind of covered this. Don't rely on any single perspective, but incorporate multiple perspectives. Presuming financial performance relative to peers is as relevant or more relevant than stock price performance relative to peers. This is an important one. Sometimes a company has a built-in economic rent or a built-in competitive advantage that allows them to outperform on a given set of financial measures relative to peers that has very little to do with contemporary performance. And in fact, in these cases, oftentimes that increased expectation is already built into your share price. This would be the case if you see a company that's consistently 75th percentile performing on, say, ROIC or gross margins, but in fact their share price continues to perform at the median or even below median of the peer group. It may be that the relative performance is not so important when thinking about what the specific goals for this company ought to be. Fixating on year-over-year performance or continuous improvement, this is important. Considering where you've come from is certainly important, but you also want to consider that if you had an incredibly strong year, there tends to be reversion to the mean in terms of performance, and the converse is true as well with a weak year. So think about growth rates as incorporating long-term perspective as opposed to simply year-over-year. Not doing a sanity check by modeling potential outcomes. Make sure you're comfortable with the kind of compensation that's going to be delivered in 3 years' time for the given performance built into your performance ranges. And then number 5, becoming too anchored to past results or circumstances. This actually is really important in private companies when you think about companies in workout situations and private investors looking to either regain lost investment over time and building in more and more aggressive goals. If you've changed over the management team, you need to think about sunk costs and make sure that the performance goals are reasonable and relevant, as we said a couple slides ago. And then finally, last but not least, is making sure that you have a plan for communicating what you're doing from an incentive compensation design, performance measures, and goal setting standpoint. This goes for both internal communication to plan participants as well as the various forms for external communication around how your executive compensation program works. And for the sake of time, I'm not going to go deeper on this slide and bring us right to time for questions.
Well, thank you, Matt, and we look forward to questions from our listeners. We've gotten a couple already, and I'll throw out 2 for the sake of time. And the first is, what's the risk that ISS and Glass Lewis and others will criticize the use of non-financial measures under the theory that they may be soft or subject to distortion? And let me preface the answer, if I could, by reminding the directors that the last time we looked, ISS and Glass Lewis don't run our companies, we do. And the most important slide in this presentation, most important slides in this presentation deal with what's the company's strategy, where is it going, where do we want it to go, and design the LTI system around that. So I'll leave it to the experts to answer the question, but as a director, I would caution everyone listening that we should look at what ISS and Glass Lewis has to say. We should determine best practices, but they shouldn't be driving anything. The second question, which is a really interesting question, is if M&A is a key strategy for the company, how should that be incorporated in an LTI program? I'll turn it to either Matt or Brett to answer both questions.
Okay, great. Thanks, Steve. And I just want to say we couldn't agree more with your preface around who's responsible for the corporate governance of the company, who's responsible for the executive compensation program. So the issue of non-financial measures. Let me start with a philosophical response, and that is you should not be shooting for an A+ on ISS and Glass Lewis tests. You should be shooting for a C. You want to pass. You don't want to be a tall blade of grass. You want to make sure that you're satisfying the low-hanging fruit around their tests of pay for performance, and more broadly, how they assess whether or not they recommend a yes vote or no vote on, say, on pay. I think you need to take a good hard look at your business environment and your business strategy and decide what is important in terms of what needs to be reinforced in your incentive compensation programs, and draw a bright line and say, this is how we're going to define performance for pay for performance, and we're going to have the courage of our convictions and stand up for it if it's going to bring some bumps along the way in terms of evaluation by ISS. Now, obviously, there are practical considerations. You don't want to be in a situation of getting no votes 2 years in a row, or even in a given year. So pay attention to the low-hanging fruit. Do the easy stuff so that you can stand your ground on the important things that might involve measuring performance of a non-financial nature and incenting and rewarding for that. Brett, I don't know if you got any thoughts on that?
No, I think at the end of the day, I think companies are probably more willing these days to go against the quote-unquote ISS or Glass Lewis wisdom. And again, I think as Matt said, it's the courage of convictions. If you're doing the right thing, then directors shouldn't let ISS stand in the way of doing that right thing. And so I think that's what it ultimately comes down to.
Yeah. Let me add one more thing. And directors should also be looking at some of these what are called softer criteria, like client service responses and other things, and determine whether they belong in the annual or in the longer-term plan.
Yeah, that's a good point, Steve. Very good. And you also asked about if M&A is part of your key strategy, how do you incorporate that? Yeah, and that is the case for a couple of our clients where it really causes an issue is trying to measure multi-year ROIC or any kind of balance sheet returns, because the balance sheet obviously can be significantly impacted by by a series of strategic events. And even if you don't have big acquisitions occurring, if you've got 3, 4, 5, 6 smaller acquisitions occurring in a given year or divestitures, the cumulative effect can be quite large. Oftentimes we say shy away from using ROIC or a multi-year return measure in the incentive plan. Rely on maybe some of the component measures to it. You might look at different measures of how the balance sheet is managed in the business. You might look at working capital. You might look at asset turns. You might look at other drivers of that long-term performance. But I do think that companies with an M&A-focused strategy are going to feel a little more gravity to use a TSR, a relative TSR measure, because ultimately, in the long run, that's what you're betting on, that you're putting together an organization that in the long run is going to produce that maximized present value of future cash flows, even if it's not showing up in the 2 or 3 years as we deal with integration.
Just to Matt's point, I would add that you don't want to create an incentive for managers to go out and do acquisitions and unwisely deploy shareholder capital. And so I think you let the market be the arbiter as to whether an M&A based strategy is ultimately successful or not.
Okay. I don't see any other questions coming in from our listeners. Have you taken a look at TSR versus EVA or anything else that you think? You commented earlier that there's no single silver bullet. Have you found a holster full of them?
Well, it's interesting. We looked at whether or not these particular measures by themselves are driving value, and the answer, we kind of figured we get the answer we did, which is no, that the measures by themselves don't drive it. But it doesn't mean that for certain measures or combination of measures within an industry aren't correlated with value creation. And in fact, an appropriately tailored EVA definition can correlate very strongly with share price performance. Likewise, a combination of ROIC and some other measure of growth can accomplish the same thing. The issue is that the goals that are relevant for your company are going to be very company specific. So, that's why we say focus on what are the centerpiece financial measures. They may very well be something like EVA or economic profit or some combination of growth and returns that are relevant for you. But the answer to how you should perform against those isn't necessarily going to come from your peers.
Okay. Well, I would like to thank our experts who have helped us through today, both Matt and Brett. I'd like to thank our listeners. We hope you have found this helpful, and we look forward to additional questions. Any questions you have, more than welcome to send in, and we will respond by email. And we look forward to your participation in future webinars. At this point, I'll turn it back to Michael.
Thank you, Stephen, and thank you, speakers, and thank you, audience.